Hi, my name is Sam Lee. I'm the CEO of NorthIsle Copper and Gold. Very happy to have the opportunity to give you a little bit of an update today. So we have a project on the north end of Vancouver Island in BC, Canada. Our project has approximately 22-year mine life of copper, gold, molybdenum, and rhenium. The distribution is about 62% copper and 33% gold. By revenue, it's about a $1.1 billion after-tax net present value at 8%, and I'm almost 20% after-tax IRR. So this is a big project. The average annual production of about 156 million pounds of copper equivalent over that life of mine. So we are looking very, very forward to developing the project, but in concert with that, we are spending a tremendous amount of time and effort on our exploration program across our 50-kilometer strike length tenements adjacent to our project and bordering up against the historical BHP Island Copper mine that's produced for 24 years with the same products that we have.
Brilliant. Sam, good to see you back. We saw you back in April, heard the story first time then. Intrigued to see what you've been doing since then. There's three things I want from you today, though, because there's a disconnect. You're a 30 million market cap company. You're talking NPV8 of $1 billion plus. People aren't quite buying it. If I'm looking at the share price, one, what's happening with First Nations discussions, and also in terms of environmental. Two, the strategy. What leads you to believe that the strategy that you're employing is correct? I think you're going to tell us a little bit about some conversations down in Denver. And three, how do you possibly stop any future dilution to shareholders? So let's kick off maybe with First Nations discussions, because you had a press release about it recently.
Yeah, just to address your question around the general markets, we're clearly in a period of stagflation. That's higher prices and low growth. And with low growth and stagflation certainly comes the de-risking of investment strategies. So we are in an environment where there's a risk-off attitude. And so that's really translated into the more risky opportunities such as ours that probably do not get the attention that they deserve in this type of environment. So our view is to stay the course. We obviously, given the fact that our management and board own over 20% of the company on a fully diluted basis, we feel shareholders' pain. But again, we're going to stay the course. We're going to advance our strategy. It's more evident as the days go by that we are entering this perfect storm relating to copper deficit. And to your question around Denver, it was quite an interesting time. Obviously, the in-person attendance wasn't as high as people would have hoped for. However, we had over 20 meetings, and I'd say that the breakdown of those meetings consisted of about a third investors, a third private equity, and a third strategic corporate development. So the smart money is certainly looking forward, and they understand that this is an environment driven by COVID that's creating a risk-off attitude for the general investor. But again, the smart money looks forward through these things and develops a strategy. It executes that strategy based on that forward-looking thinking. I do have to say there are probably over 6 copper M&A processes in the market today that's known, at least that's known to some, and there's probably over 12 in the pipeline. So I absolutely believe, and I've been saying this for months now, that copper M&A is going to happen fairly soon. And once it starts happening, it is going to filter down and it's going to be a very, very active market. I think what we're seeing now is just because of COVID, due diligence isn't, you're not able to see as much due diligence. You're not able to go on site, kick the tires, and do proper work on opportunities to give you enough confidence to make a bid. I think once the market opens up, or at least the general world opens up for these types of activities, you're going to see really a lot more activity on the M&A side. So we're very, very confident that if we keep our heads down, stay the course, the market is going to, quite frankly, recognize our strategy.
But give me more than that, Sam. Give me more than that. Okay, smart money, because they like what you're doing. They're smart money. Okay, so what exactly do you mean by smart money? Who are they, and what makes them smarter than the rest of us?
Sure, they take a longer term perspective of the commodity, right? So we obviously are about 65% copper, but we're also 35% gold. So that's 100,000 ounces of recoverable gold for 22 years. That is a massive gold component. So putting it in context, and I think I mentioned this last time, if you were to put a stream, last money in, 5% discount rate, $400 ongoing payments for 22 years, that stream is worth US $1.2 billion. That is the entire amount of our CapEx. Clearly, we will not do 100% of the stream. Clearly, we will wait to the right time to monetize that stream or a portion of that stream as we go through each stage gate. But Matthew, you asked, about dilution. What is the first thing we know about dilution? Well, if your cost of capital is less in one product versus another product, then you typically use that cost of capital. So if you were to back calculate what our implied cost of capital is based on what we are currently trading today, it is over 20%. If you were to calculate what our cost of capital is today, based on what the three analysts that are covering us today is, that is over 15%. So their target prices are based on something close to 15% cost of capital. So if you're telling me that a royalty company is willing to pay you a significantly less cost of capital at any given point of each stage gate, I think that makes sense. I think that obviously we probably wouldn't get 5% today, but we would definitely get 5% or even less. I've heard even negative cost of capital once you get closer to production, because these royalty companies are abundant and they clearly have to deploy money very quickly. But of course, a negative cost of capital is associated with a producing asset. But I don't think it's unreasonable to get a cost of capital that is significantly lower than what we're currently trading at today. So anyway, there's lots of options. We only could do this and contemplate these types of alternatives because we have a massive gold product. And that's why we were invited to the Denver Gold Show, is because 35% of our product is gold, 100,000 ounces a year. That's over close to 9 million ounces of gold equivalent in our resources, in our inferred resources,
right.
Indicated resources.
So lay it out for us, guys, the not so smart guys. Lay it out for us and say, look, we're 30 million market cap today. We raised $7 million back in March. We've got exploration program going on. We've got G&A to cover here. We're flying analysts and brokers in and out of camp. It all costs money, right? Today, your money's expensive. So lay out how you do the best non-dilutive program to get past the PEA, which you've got today, into the next phase, which just tells the market a little bit more around the economics of this thing. How are you going to do it?
Okay, very good. So clearly everyone is fixated on the $1 billion CapEx, right? Which in my mind is actually a medium-sized copper project. But as I just explained to you, the gold component is massive. And the gold component alone addresses the entire capital expenditure and then some. Okay, so let's just leave that to the future, because that's the third stage gate. Today we've just passed the first stage gate, which is the preliminary economic study. We then move to the PFS, which is another stage gate. And you said we raised 7, but we actually raised 10. If you combine the two offerings that I did, there were 2 tranches when I first joined in October, and that's quite frankly my specialty. I'm able to raise capital for growth initiatives. So the next growth initiative here and de-risking is the pre-feasibility study. Well, that's not going to cost $1 billion. That's going to cost more of the same, right? And as we go through stage gate to stage gate, we finance those individual stages. And as I said, at these prices, we are not going to blow our brains out and over dilute shareholders. Trust me, as a shareholder, as a principal, and as a group owning over 20% of the company, we feel dilution more than anybody. And that's why we did both of our offerings without a warrant. This was a very uncommon act when I joined last October, and I think we were one of the first to raise their capital without any warrants. So our balance sheet is clean. There is no encumbrance of upside potential here. There's no outside of options, obviously, because of course, within the first year, I did not take a salary. I took it all in options. So this is a very important note. We're all focused on growth here. We're all focused on the opportunity. We clearly believe that this is a very devalued point in the market. And that's why I joined. I could have, I've obviously spent over 20 years as a banker for a major bank. And for me, the opportunity was to get in at these levels. And so while, as I said, if some of the investors look backwards and say, well, why are you trading at such a low multiple? This to me is the opportunity. This is why we do what we do. And this is why I do what I do, at least. So, I do think that we've got a number of stage gates ahead of us. I think that we're fully financed for this stage gate that we're in right now, which comprises of exploration. So all of the 10,000 meters of drilling that we're doing this year is all exploratory. None of it is infill. It's all targeting new discoveries and expanding our current project.
So tell me this, Sam. Okay, in a market where copper prices have done it, they've gone past what's copper at now?
It's 440, I believe.
440. I was going to say 425. Right, okay, 440. It's done so much heavy lifting for you, but the market's going, do you know what? We're not going to give you any credit for that because we need to see you go through these stage gates, is the phrase that you're using now. So what, at the end of the next stage gate, what is it that you're coming to market with, hoping to come to market with, which should get people to go, okay, they're doing what they say they're going to do. The numbers look okay. The exploration is, I don't know what is showing. I mean, what do you think you need to show to the market to get them to pay attention?
So I'd say that it's not as simple as people waiting on news flow, right? Right now, as I said, this disconnect between high prices and low growth and low risk appetite is the product of stagflation. And that's happening. Everyone can acknowledge that we're in this environment. So I would almost maintain we throw out any news, any company, any junior company that is, a high risk company, which we are clearly high risk, high reward, will not benefit from that news flow. Okay. And that's just the environment we're in. And I think we all are adults. And as long as we're able to keep on going without stopping, without slowing down in this environment, which we're doing, then you're positioned. It's just like a retail store during COVID. The retail stores that survived COVID are the ones that are going to perform the best. They're the real businesses because they prepared for it and then they didn't stop during the period of shutdown. So we're just the same type of company. We armed ourselves to advance our strategy, our stage gate strategy, with enough money to do it, and we have enough money to do it. And that mostly entails development of our project. So we've earmarked $1 million of our over $10 million that we raised towards project development and critical path items. So what does that mean? Well, it's First Nations. You talked about First Nations. Well, in BC and in Canada, all roads lead through First Nations partnership community. It's reconciliation before it becomes official, right? And so that is our absolute fundamental belief through, not only just doing the right thing, but these are our neighbors. This is a 7-hour drive. The project is a 7-hour drive from where I live. It's a 1-hour flight. We can literally get on the property in an hour and 15 minutes from South Terminal in Vancouver. So these people are my neighbors. They're my community. That is how we approach our discussions. We are one. There is no, applying a different standard because they're somewhere across the world. This is the exact same standard as I would apply to my neighbor. And so I think thus far, that has been a very, very effective approach. as it relates to dealing with First Nations communities. What does that mean, and how does that translate into something that's material? Well, it's a participation agreement. And that participation agreement is going to be critical to ensure the development of our project and staying within a very, very tight time frame to get this thing built and in production within this incredible demand deficit, supply-demand deficit that everyone is calling over the next 10 years. And so that is critical step number one. We've applied $1 million to that. The second portion that's fully financed is our exploration work, right? So I think as the last time I spoke to you when I was here, we initiated the 2021 program in March, starting with Pemberton Hills, then moving to Northwest Expo, Red Dog, and then Hushamu. And all three have very distinct exploration characteristics. Pemberton Hills was the blue sky, greenfield exploration program that we've focused on with Freeport and triangulated on an area, and we put a couple of holes down. So what we found around that exploration program is the system is much larger than what we expected. We went through 1 kilometer of highly altered lithic gap. The system is tilted and the system is deeper. So this is critical information as it relates to our overall strategy, which is our current operation as defined by the PA is a starter pit. So the question is a starter pit to what, right? And this could potentially be a massive, massive deposit, right? So given all of the geological characteristics, this is something that could be the game changer, but it's extremely early stage. So we are going to pursue that methodically and systematically, but all that to say, the drill program yielded good information for us to target it going further. We are currently right now in our Red Dog Northwest Expo drill program. And so just as a reminder, that's to test at Red Dog, the down dip extension of the ore body. And then Northwest Expo is to test the chargeability. And also there were 2 historical drill holes that hit 1 gram per ton over 100 meters through what we believe is a porphyry, right? So this is quite significant. And we're currently focusing on that, drilling that out, defining the trend and seeing what the continuity is around that. Again, new discovery. The third part of the exploration program is going to happen after we complete that, and hopefully in a couple of weeks. And that's around Hushamu. Hushamu is the much larger, much more consistent, higher tonnage ore body that tilts to the southeast. And we're just continuing down that trend. We're just stepping out to the southeast. And, I think you talked about overall strategy and materiality. I think in any majors incumbent's mind, the threshold for materiality is about 1 billion tons. We're currently around 900 million tons. And through these programs, especially the more predictable ones in terms of Hushamu, I believe we can surpass that in quick order.
So if they're looking for 1 billion, you're at 900. Why aren't you doing infill drilling? Why are you focused on exploration? And while we're at it, you labeling something as a starter pit says to us that you're laying out a plan for a strategic. Is that sort of the information or sort of the conversations that are coming back at you when you were down in Denver?
Yeah, so we're definitely taking a balanced approach around size, right? So I think the strategy around the starter pit, so we're 75,000 tons per day. So that's kind of the size operation of a Gibraltar, for example, Taseko Gibraltar, right? So that's something that's manageable by an intermediate, but it's small for a senior company. We've seen in the market this, I guess, perhaps regression away from these massive deposits that have very little chance of being developed to something smaller, something more developable, something that has brownfield existing infrastructure, but has also the ability to expand into something much larger after a project such as ours, like 22 years, mine life is not insignificant, but that's enough time to find, define, permit, and build a world-class mine, right? And so if you could see the sequencing and how strategics think about it, that's a very appealing thing. And so we're starting to see a little bit more activity. Again, the last cycle that we saw, and I was heavily involved with on an M&A, on the M&A side, it really was all about tonnage. It really was, what's the tonnage, and of course, what's the grade? But tonnage almost superseded grade during the last cycle. Now what we're seeing is, okay, what's the developability? Do you have the social license? Do you have infrastructure that already exists? I already mentioned to you, I could literally get on our site from Vancouver South Terminal in an hour and 15 minutes. And I could drive, and we've been doing analyst tours all summer. And it is just remarkable to see how, this conceptual lock that exists around mining or building a mine in our area, how it just vanishes when they literally get on site in an hour and 15 minutes. They drive the entire property, 50-kilometer strike length property, right? Then they take a helicopter and we fly over BHP's Island Copper pit, which is just to the south of where we are, literally adjacent to our tenements. And they see what, the great work that BHP has done in terms of reclamation of that mine, and potentially, the use of the infrastructure, brownfields infrastructure is there for us. They see the road networks. They see how close Port Hardy is. It's only half an hour. There's no fly-in, fly-out camp here. It's literally a 5,000 person city that was, I wouldn't say built by BHP Utah, but it certainly was, it grew to the extent that it is today because of that mine. And so that community support is still there. That recognition, that history is embedded in the community. And we've seen nothing but tremendous support from that community. The First Nations group that worked with BHP, that had BHP's partnership, is the exact same First Nations group as ours. And to show their support beyond this participation agreement, which we'd like to agree to shortly, but beyond that, they've actually already purchased BHP's mine or area, but for the mine and the foreshore, because BHP is currently reclaiming that area, which is a huge indication of their support for our project, because the most effective use of that area, concentrate storage facility, mechanical facilities, is another mine that's 25 kilometers away, right? So this to me is an excellent outcome, because they are now economically incentivized to bring this forward. They've told us that this is what they want to use the land for. And as I said, we just have to get to that point where we have an agreement in place that defines clearly what the participation and the consultation looks like. And again, I'd like to have that out fairly shortly.
It's interesting when you use the phrase world class. I think you went on to sort of, well, certainly intimate it. World class means something different these days, because copper mines, typically majors, even the mid tiers, you need big projects, billions of dollars of capex. And we've seen a lot of small copper companies come through, and that they're not going to interest mid tiers or seniors. But world class means something different these days in terms of the way that projects get developed. And I'm sorry to keep coming back to these conversations in Denver. Is like the way that people are looking at developing projects now and funding projects that they will fund. It's the ESG, it's the environmental. There's a different set of tick boxes these days, it seems. I mean, was that, again, part of the discussion down there?
You're absolutely correct, right? World class has changed. It has to be more focused around ESG. What is the right size of the project? How do you do things in a sequenced way where you don't make this massive impact initially? World class also has differed in terms of grade expectations, right? So, for example, Escondida was a 3% head grade when it was discovered, and clearly that's the standard of world class. But the reality is they've actually gone down to approximately 0.6% head grade today, right? So if you think about the broader context of the copper markets, Goldman Sachs, Wood, Mackenzie, everyone's calling for 8 to 9 million tons of copper deficit by 2030. That's like 8 to 9 Escondidas of incremental production that needs to come online by 2030. And the fact that Escondida has gone down from 3% to 0.6%, that's a 5 times more waste to ore. So you have to produce 5 times more waste now at Escondida in order to produce the same pound of copper that you did before. So that incremental production is not coming from Escondida. And quite frankly, I haven't seen another discovery, perhaps outside of Kamoa, as coming online. That's that high grade, and we need 8 of them to not only run to stand still, but to get to the point we need to be in the next 10 years. So my absolute belief, and I think I believe the strategics are thinking the same way, is that production is going to come incrementally, because to develop an Escondido or a Resolution, that is going to be decades in the making, right? Decades in the making. It doesn't satisfy the next 10 years. So again, the common refrain is, what is going to happen in the next 10 years when we have this 8 million ton deficit? Well, it's incremental production. It's the developability of a mine that's going to shine through as it relates to investors, intermediates, and seniors alike.
Okay. Do you think that you've answered my three questions in terms of, right, First Nations, I think you explained that one. I do think you explained that one. In terms of the strategy for a 30 million market cap company, moving this thing down the stage gates, and indeed the dilution question, do you feel that you've done a good job in explaining that today?
Yeah, I think the other really important, keep in mind, I was at a gold show, right? So it's a different perspective than perhaps copper companies. And one of the themes that I discussed with a number of precious metal CEOs is this concept of global materiality, right? As we all know, gold is a very sort of tight-knit community, right? It's kind of a tiny fraction of the overall global markets. It's a currency that everyone relies on, as they should, quite frankly, in times of turmoil, and there's value to be had in that option value, right? But it's not a global commodity, and it's not a commodity that has as much breadth and depth as some of these base metals, including copper. And of course, the theme here, and part of the reason, again, why I think we're invited is, copper is almost the new gold in terms of that, in the option value, so to speak. But the interesting thing about copper is, because the breadth of the market is so deep, you've got so many other alternatives to finance projects. So for example, everyone knows copper or gold companies. The reason why they're so successful in financing is you got really cheap cost of capital. You've got smaller projects. It's all equity risk, right? But copper projects are different, because our concentrate is so clean. It's high purity. It's low arsenic. It's low deleterious elements. It's good, 25 to 30% concentration of copper. It's got gold in there, because that, and it's been obviously tried, tested, and true through BHP's operation, Island Copper operation, which is effectively the same extension of our system. Companies like Sumitomo and the Japanese, the Mitsubishi, the traders, the off-takers, they all need this type of quality concentrate. And in the past cycle, we saw a lot of activity, corporate partnership, strategic activity, just to get from that group of individuals, just to get access to that premium concentrate. And I've just named a few, and that group, quite frankly, has grown over the last few years, which gives you, again, another way to access lower cost of capital, certainly, than what we're experiencing today from an equity perspective. So, obviously, I'm a banker. I understand cost of capital extremely well. I understand what's available to us. It's what attracted me to this deposit specifically, because there are a lot of options around financing and reducing that cost of capital for this project.
You've been there a year. Could you have done more?
Could I have done more? Look, I think it's a very, very delicate balance between raising the amount that you need versus raising the amount that's available to you. And so there was certainly a period of time during January to call it March where we could have accessed a lot more capital than we did. But we remained extremely disciplined because we had the strategy laid out. We had our budget around these critical path items that we knew what the cost would be. And again, because we were all shareholders, we did not want to over dilute. Okay, so I think the only thing that perhaps we may have been able to do differently is raise more money, right? Because it was abundantly available to us. But I still maintain that I don't think I would have made any different decision of raising $10 million instead of X amount, because we didn't need it, and we fully financed, and we are currently still fully financed for this absolutely critical stage gate that's in front of us that we're going through today. So, from that perspective, I think that we are in a very strong position. In terms of what we've done, if you think about it, we took an asset that was totally orphaned, and we took a management team that, quite frankly, was reasonably stagnant. And we've added the people that could move this project forward through these stage gates. And I would say we got top quality people, right? So the first person that during this period that I brought on was Kevin O'Kane. So Kevin O'Kane spent 40 years or 37 years at BHP, and then spent the last 2 years at Silver Standard, or SSR, as his chief operating officer. So Kevin was actually the chief mining engineer for BHP at Island Copper, right? So getting that institutional knowledge around a project that is, again, so instrumental in our understanding of our project, I think was critical, right? So getting him to join a $20 million market cap, $15 million project was absolutely fantastic. He's also on the board of SolGold. Then we got Nick Van Dyke, who's our current CFO. Again, long history of investment banking. He's also been an executive for a company called Polaris that owned the Orca mine that sits, just south of where we are, so dealing with the same First Nations group. A very important individual. Our third hire was Michelle Tanguay, who is the head of sustainability and community and environment for GT Gold. Now, Michelle actually worked for Newmont in the past, and also for Argonaut, developing the Magino mine. But for her to come to us and choose us as the next opportunity, as opposed to going back to Newmont or whatever her other options were, and they were plentiful for sure, is a huge, I think, endorsement that she believes that she can have a tremendous impact on our company, on our asset, on our share price, by doing the right things around communities, First Nations, etc. That was our third hire, right? And then, of course, our fourth, which is our VPX, that was really kind of rounding out the succession planning around my predecessor, Jack McClintock, who's best known for discovering Spence for Rio Algo, now obviously within BHP's more material assets. So Jack remains as our strategic advisor, just given that he's been around this project for over 15 years, and he was obviously the CEO that advanced it up to this stage today. But getting Robin Tolbert, I don't think we've missed a step. He has just as much experience in terms of years as Jack. He's got extremely good global gold porphyry experience, working in Indonesia, working in Arizona, working in Yukon, and so on and so forth. So, in terms of building out the team for what we need, I think we've done an extremely good job, an effective job of positioning ourselves to execute, again, this vision. In terms of marketing, because that is a question that does come up, are you spending enough time on the retail circuit? And I think that, obviously, Matthew, you've been, instrumental to have the access to the people that you have access to is tremendous. And I do think that we are very selective in terms of who we choose to go marketing with, because I come from an institutional background. So does Nick. So does everybody, in fact, in our company. We're all big company people: BHP, SSR, Newmont, CIBC, et cetera, right? So there's a I should say almost a cautious approach as it relates to how we market and what type of marketing do we do and through whom do we do this with. Because we certainly do not want to get to a point where our reputation is in any way impaired, right? So there's a famous quote: "It takes years to build a reputation and seconds to destroy." So we want to maintain our 200 years of reputational experience, and ensure that we're doing this right and methodically. And so a lot of our focus has been on the institutional community, and I think certainly On the retail side of it, we go through organizations such as yourself, credible, heavy breadth, heavy return organizations to establish a retail presence.
Okay, I think that's wise. You mentioned the team, so it's the right team with stagflation, the wrong time. Is that what you feel?
I don't know if this is the wrong time. Like there's the time. The time is very. I always say that the best time to finance a mine is at the top of the market. The best time to build a mine is at the bottom of the market. The best time to produce the mine is when it's going up again. So if you think about the traditional cycle of any commodity, let's just call it 5 years on, 5 years off, right? And I truly believe we're in the first or second year right now of the copper cycle, at least. Gold is a little bit longer at this point. But in the copper cycle, I believe so if you think about our game plan, right, to essentially be at a point where we have a production decision and financing it in 4 years from now, right, which is going to, when you get to the 4 years. So we are going to be able to finance that $1 billion capex that everyone is freaking out about in the best time of the cycle, right? And then we're going to be able to develop it in perhaps the best time of the cycle as well, because as everyone knows, as the market goes down, and this is all very theoretical, I'm not saying the market is going to go down, but as the market weakens, availability of labor, of equipment, of everything else gets cheaper and more available. And this is probably going to be a 2-year build. So we hit that part of the cycle beautifully. And then once we start producing, we're going back on the uptick. And this is a generational mine. It's 22 years plus. So, again, I think your question is a good one, because I think that a lot of people share that perspective. I know you don't, but you asked the right question, which is it's so backward thinking, right? It's so current thinking. It's you look at the share price, you look at where we are today, and you're like, oh my gosh, this is a terrible time to be part of this. But in our views, we're much more longer term. And again, the people that we talk to are much more longer term. And this is actually the perfect time to be doing exactly what we're doing.